2026 condo financing changes, what buyers and realtors need to know. If you're buying or selling a condo, or you're a realtor who works with condo buyers, there are some important new conventional loan guidelines that took effect on August 3rd, 2026. And these changes could make the difference between a condo being financeable or a perfectly qualified buyer being unable to get a loan. So in this video, I'm going to break down what's changed with conventional condo financing, what hasn't changed with FHA and VA financing, and what I think buyers and realtors should be doing differently going forward. Let's start with probably the biggest change. Until recently, many conventional condo transactions could qualify for something called a limited review through Fannie Mae or a streamlined review through Freddie Mac. Basically, this allowed certain established condo projects to receive a less extensive review. That changed for conventional loan applications dated August 3rd, 2026 or later. Fannie Mae eliminated limited review, and Freddie Mac made a corresponding change to its streamlined review process. As a result, many condo transactions that previously qualified for the easier review process will now need to go through a full project review, unless they're eligible for one of the available project review waivers. Why is this important? Because when you're financing a condo, the lender isn't just approving the borrower. We're also approving the condominium project. You could have a buyer with an 800 credit score, 20% down, great income, and plenty of money in the bank. And the loan could still potentially be denied because of a problem with the condominium association. What does a full condo review look at? With a full review, there can be considerably more scrutiny of the condominium project. Depending on the circumstances, we're potentially looking at things such as the HOA's budget and financial condition, how much money the association is putting into reserves, special assessments, delinquent HOA dues, the project's master insurance coverage, pending litigation, deferred maintenance, structural or safety problems, critical repairs, and other characteristics of the project. This is especially important with older condo developments. A project could look beautiful from the outside, but if the HOA has been underfunding its reserves for years or has significant deferred maintenance, that could potentially create a financing problem. Reserve requirements are also changing. There are actually two important dates realtors and condo buyers need to know. The first is August 3rd, 2026. New requirements took effect regarding how reserve studies can be used to demonstrate adequate reserves. If an HOA isn't meeting the standard reserve budget requirement and we're relying on a reserve study instead, Fannie Mae now requires the budget to include the highest recommended reserve allocation contained in that reserve study. Fannie Mae also eliminated what's known as the baseline funding method, which allowed reserves to potentially decline towards zero without actually becoming negative. But there's another important change coming, beginning with applications dated January 4th, 2027. The standard replacement reserve requirement for a full review increases from 10% to 15% of annual budgeted assessment income. Freddie Mac is making a corresponding change. So, as I'm recording this in August 2026, the standard benchmark is still 10%, but beginning January 4th, it becomes 15%. That could be a big deal for some HOAs that have historically tried to keep monthly dues low by contributing less money toward reserves. There's also some good news. Not every change makes condo financing more difficult. Fannie Mae expanded its waiver of project review for certain smaller condo projects. Under the new guidelines, certain new and established projects containing 10 units or fewer may potentially qualify for a waiver. There are additional restrictions, particularly for projects with 5 to 10 units, so this isn't an automatic approval. But for some smaller condo developments, this could actually make financing easier. Investor concentration rules were loosened. Here's another positive change. Fannie Mae eliminated its previous 50% investment property concentration limitation for established condominium projects undergoing full review when the subject transaction is an investment property. Freddie Mac similarly retired its 50% owner occupancy requirement for established condo projects. That could help in communities with a high percentage of renters. However, don't confuse that with the requirements for new condo projects. Certain pre-sale and occupancy requirements still apply to new or newly converted projects. Condo insurance has become a major issue over the last several years, particularly here in California. There were additional Fannie Mae and Freddie Mac insurance changes in 2026. One important change allows a condominium master insurance policy under certain conditions to have a per-unit deductible as high as $50,000. However, when there's a per-unit deductible, or when portions of the unit aren't covered by the master policy, the borrower may be required to carry an individual H06 condo insurance policy. So when we're looking at condo financing, we need to pay attention not only to the borrower and HOA finances, but also to the association's insurance. Now let's talk about FHA. This is an important distinction. FHA did not adopt the August 3rd Fannie Mae and Freddie Mac changes. FHA has its own condominium approval system through HUD. Generally, we have two possible paths. The first is an FHA-approved condominium project. The second is what's called a single unit approval, or SUA. A single unit approval may allow an individual condo in a project that isn't FHA approved to qualify for FHA financing, provided both the unit and the overall project meet HUD's requirements. So here's something important to remember. A condo that has a problem qualifying conventionally isn't automatically disqualified from FHA financing. We have to analyze it separately under FHA's rules. What about VA loans? VA also operates under its own condominium approval system. VA did not simply adopt Fannie Mae and Freddie Mac's August 3rd changes either. For VA financing, one of the first things we want to determine is this condominium project VA approved? VA maintains a list of approved condominium projects. If the project isn't approved, it may potentially be submitted to the VA for approval, but that can require additional documentation and additional time. So for a veteran buying a condo, this is something I want to investigate before they get too far into the transaction. Here's my biggest advice for realtors. If you're a realtor, I think these changes make it more important than ever to involve the lender before your client writes an offer on a condo. Don't assume that because there were conventional loans in that community a year or two ago, the project is still going to qualify today. And don't assume that because your buyer is exceptionally well qualified, the transaction is automatically safe. The borrower could qualify perfectly. The building may not. That's why I recommend having your lender investigate the project as early as possible. If there's a known eligibility problem, we'd much rather discover it before your buyer spends money on an appraisal, inspection, and other costs, or gets 2 weeks into escrow and suddenly discovers they have a financing problem. The bottom line, the big conventional condo changes to remember are these. August 3rd, 2026, limited and streamlined reviews went away for Fannie Mae and Freddie Mac, and new reserve study requirements took effect. January 4th, 2027, the standard reserve allocation requirement for full reviews increases from 10% to 15%. Meanwhile, FHA and VA continue to operate under their own condominium approval systems. So if you're considering buying a condo or you're a realtor representing somebody who is, please reach out to me early in the process. We can take a look at the property, determine which financing options may be available, and try to identify potential condo eligibility issues before you write the offer. I'm Adam Heaney with the Adam Heaney Home Loan Team. You can reach me directly at 949-293-2551 or email me at adam@heaneyhomeloans.com. And if you found this information helpful, please share this video with a realtor, condo owner, or home buyer who needs to know about these changes. I'm here to help you navigate the mortgage process with confidence.